So we think our policy stance is appropriate today, and we're prepared to adjust it going forward as we see appropriate. And today, we believe that particularly this very strong forward guidance, very powerful forward guidance that we've announced today, that should be a very powerful statement. This very strong, very powerful guidance, and we expect that our guidance is powerful and will help that outcome. I think that the forward guidance we adopted today is appropriate and, as I mentioned, powerful. I think over time, it will provide very powerful support. Is a strong and powerful thing. And so those are powerful commitments that we think will support. Our rate policy stance is an appropriate one to support the economy. We think it's powerful, and it is strong, powerful guidance. It ties. However, these one-time increases in prices are likely to have only transitory effects on inflation. I would note that a transitory rise in inflation above 2%, and they'll disappear over the following months, and they'll be transitory. They carry, and FOMC participants have revised up their projections for inflation, notably for this year. As these transitory supply effects abate, these bottleneck effects have been larger than anticipated. But as these transitory supply effects abate, the concept of transitory is really this. Not saying they will reverse. That's not what transitory means. It means that what I mean by transitory is just something that doesn't leave a permanent mark. However, these one-time increases in prices are likely to have only transient effects on inflation. I would note that a transitory rise in inflation above 2%, inflation that has reached 2% and not just on a transitory basis, and if we want inflation at 2% and not on a transitory basis, and we want it. On largely, there are a bunch of factors. We think it's very fair to say that the increases we see, and frankly are about to see later this week, are largely due to base effects, because there are some things that are always going up, and so we just said largely.
We're going to turn to the other major news this Friday night on the economy and the prices you're paying. You don't need us to tell you what you're seeing already. The new report out tonight showing inflation is now near a 40-year high in this country. Consumer prices up 0.8% last month alone. Year to year, prices up now 6.8%. Americans are paying more for gas, food, clothing, and cars.
Shit.
All right. Today is Sunday, December 12th. This is a recap for the stock market activities last week and an outlook for the week to come. Folks, I got a good one for you tonight, and let's not waste any more time. Here it is. In focus tonight. What else? The review of the CPI and the implications it has on the economy and the stock market. Let's start by this. Before the reading came out, our expectations were high, matter of fact, sky high, that the number will be hot, the hottest reading in 40 years. Matter of fact, before the release of the number, the Biden administration came out to massage our inflation expectations, and they sent out their BlackRock representative, Brian Deese, who said, you know what, all of these declines in energy prices from the release of the Pokemon variant, well, you're not going to see those declines in this report. And I thought that the administration has no connection at all with the BLS, that the numbers are sealed. And this is all bullshit, of course. We all know that the White House knows exactly what the numbers are going to look like ahead of time. And this, of course, happened during the Trump administration, and now it's happening under the Biden administration. They always know ahead of time, and they try to play out expectations to protect the stock market, of course. And here is the reading. Inflation is red hot, soaring to 6.8% in November, the highest reading in nearly 4 decades. So the number came out hot, 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 yet matching expectations, not exceeding them. And the stunning fact, of course, in this report is food inflation. Everybody talks about energy and gas inflation, and we all know what's going on here right now. They're denting these inflation expectations when it comes to energy prices by the release of the SPR and all the games they're playing to dent energy prices at least temporarily. And you and I know, whatever they do, energy prices and crude oil prices will continue to recover and go higher and higher and higher until the Fed starts raising interest rates. So yes, let's say that the report for December comes out showing inflation is slowing down due to the dent in energy prices from the release of the Pokemon variant. The market will have a massive orgasm. You're going to see the experts on CNBC and the media coming out and saying, you know what, the Fed has to slow down. Inflation is already slowing down. And this will be the biggest mistake in Federal Reserve history because energy prices will pop higher again. And I will explain to you all of that in a little bit. But the stunning fact shocking the Fed and the Biden administration is the inflation in food prices. Inflation is migrating from one place to the other. You can dent the inflation in energy prices temporarily at least, but what do you know? Inflation in food prices is surging higher. Inflation in rents and shelter also picking up higher. What does that mean? Inflation is widespread across the economy, and this is what's shocking the Fed and pushing them to tighten the policy sooner and harsher than expectations. When we look at some of these numbers year over year, they're absolutely stunning. When we look at bacon, beef, pork, all rising double digits year over year. Poultry, fish, eggs, all kind of meats. The inflation year over year is absolutely stunning. And it's no wonder why Americans are being pushed to consume spam since actual meat is too expensive. And it's not just meats soaring higher. Year over year, milk prices are rising by over 6%, fresh fruit 5.8%, soft drinks 7.4%, coffee 7.5%, cooking oil almost 13% year over year inflation, peanut butter almost 7%, and so on and so forth. And this inflation in food prices is causing massive worries of starvation, not just in poorer countries, but even in richer nations, the likes of Canada. Food insecurity surging higher, causing hunger, pushing demand for food banks higher. And if this is happening in a country like Canada, think about what's happening in poorer and less civilized countries. You know, like the United States of America, where we're becoming desensitized to homelessness and hunger and all other problems, brushing them off as the new normal. But here are the facts when it comes to the CPI. And you and I talked before, and we discussed the fact that we don't look at year-over-year numbers. And the reason is we know that the year-over-year numbers are going to be inflated due to the base impacts. But what about the month-over-month? Because if inflation is rising higher month-over-month, then this is problematic. But if we have signs of slowing down, you're going to spot that from a month-over-month reading, not a year-over-year. So let's take a look at the decreases month-over-month. Price decreases month-over-month. And this is, of course, according to the CPI, aka the CPI. Let's start by, and this is flour, by the way, not cocaine, right? It is down 1.3% month-over-month. How about frozen pies? Down 1.1%. Ham, down 1.8%. Turkey, nobody wants turkey anymore. Down 1.9%. Eggs, this is good, down 1.8%. Ice cream, thank God, down 1.7%. But mind you, price inflation for ice cream last month was over 2.5%. And the numbers year over year are stunning. And therefore, whatever declines you see right now, we have a long way to go. And by the way, prices will never go down as you might expect. We'll talk about that in a second, but here it is. Apples down 1.8%, oranges down 3.1%, and potatoes. Let them eat potatoes because they're down 9.3% month over month. What about canned fruit? Down 2.5% month over month. And here it is, that's not cocaine either. It's actually more addictive. It's called sugar. Sugar prices are down 1.5% month over month. And what about America's favorite suicide weapon? Butter, well, that is down big, 3.7% month over month. So if you want to clog your arteries, this is the time to do it. Then we have appliances. They're down 1.3% month over month. The numbers year over year are stunning. Prices still up double digits. Laundry equipment, that's down month over month, 1.3%. And then we have apparel down 1.6%. And here it is, folks, jewelry down 6.2%. Wow, what a relief. Let them eat jewelry. And then we have TVs. TVs are down 2.8%, and admission to sporting events down 4.8%, and lastly, video discs, they're down 3.7%. Wow, what a relief. Inflation is slowing down, folks. You see, video discs are down. Come on, man.
Come on, man.
What about price increases, though, month over month? Just in case consuming video discs is not to your taste. The price of rice up 1.5% month over month. Likewise, bread also up 1.5% month over month. Muffins up 1.2% month over month. And son of a bitch, even donuts. Donuts are up 3.5% month over month. I was just being thankful for ice cream prices going down. Now they hit my donuts too. Anyways, what about roast beef? That's up 1.8% month over month. Actual beef up 2.5% month over month. Pork up 3.7% month over month, and frankfurters up 3.7%. What about chicken? Up 1.4%. Fish, stunning, 3.4%. Milk up 1.4%. Lettuce up 6.9%. Wow. Tomatoes, 2.2%. What about dried beans? That's up 3.1%. Snacks, up 1.6%, and even salt up 1.8%. Notice the inflation in condiments, spices, all surging higher month over month and year over year. What does that mean? You might want to think about a name like McCormick, the ticker MKC. By the way, a lot of call options buying in MKC. We're going to cover the charts in the charts analysis. But here it is, even olives up again, 2.1% month over month, and salad up 2.3% month over month. What about clocks? If you're into that kind of thing, up 1.3%. Auto parts up 1.1%. Used cars up 2.6%. And rubber tires up 1.3%. Gift wrap up 2.8% again, month over month. Health insurance up 1.7%. And you wonder why stocks like UNH, United Health, for example, doing better than ever before. Your health insurance cost is surging higher and higher and higher. What about car rental? That's up 2.3%, and public transportation up 3%. Month over month. Airfare tickets up 4.4%, and photography services, that's also up month over month by 2.5%. And right away, the propagandists came out of the woodwork saying, you know what, perhaps inflation is peaking. And here's your favorite, Gianna Smilik from the New York Times, who, by the way, asked, is it going to be inflation or wage inflation that's going to win? And if you're going to ask that question, you might want to go back to school. But here it is. She says they're hopeful. We might hit peak soon. Rent increases are cooling off based on real-time trackers. Energy prices have come down a bit. Economists expect used vehicle inflation to moderate. Really? And here's why we call it the CPI. Because rent inflation year over year, according to the CPI, is 3.9%. This is garbage. It's bullshit. You and I know it. When we look at rent increases for various cities in America, year over year in Phoenix, 22%, Tampa, 20%, Las Vegas, almost 20%, Atlanta, almost 17%, Nashville, 13%, Portland, over 11%, and so on and so forth. By the way, this is from August. The updated version shows New York City up over 22% year over year in rent prices. So rents are surging across the board by double digits. Yet the CPI says it's only 3.9%. And this is done by design, of course, to downplay the true nature of inflation in the economy so the Fed can remain accommodative to prop up the stock market higher and make the rich richer. And here is Senator whatever Crapo who came out and said, you know what? Inflation is surging higher since the Biden administration, yada, 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 is adding more troubles to consumers. They're playing politics, of course. Why not? And in a response to this tweet, another media propagandist, Carl Quintanilla, who used to be rational and fair a while back, but since he got the orange man disease, is all in full propaganda defending this administration, even if that means manipulating the facts. And I called him out, of course, and he blocked me on Twitter, just like the rest of the CNBC anchors. They're all blocking me, and the reason is they cannot handle the truth. Carl Quintanilla says, yeah, you say Americans are suffering from this inflation, right? Well, look at bank deposits. They're through the roof. And I say, you know what? If you lump me, Bezos, and Musk, yeah, our bank deposits are through the roof. You take Musk and Bezos out of the picture, it looks drastically different. Matter of fact, our savings rates are down below pre-pandemic levels. So all of these savings from the stimmies, poof, gone. And here's from the Washington Post. They say inflation pinch challenges Biden agenda, but president says worst will soon pass. And of course, they're propping you up for the next reading of the CPI, after the Pokemon variant, of course, denting energy prices. Assuming that energy prices will take a little while before they recover, then the reading of the CPI in December will be down. I'm telling you right now, right here, right now, the reading will be down, and we will have the biggest orgy in stock market history, and perhaps in business news media history. You're going to see all of these CNBC propagandists smile ear to ear. But here's the problem. Inflation will come back stronger. You want to build back better? Inflation is going to be built back better and bigger and stronger than before. And in tomorrow's video, we're going to go over the 1970s inflation. And I will show you that every time they dented inflation via manipulation and via the fiscal policies, inflation came back stronger with such ferocity that surprised everybody. And there are two reasons for that. Number one, remember what Criminal Powell said about inflation. He said that by transitory, we don't mean that prices will go down. When prices go higher, you're going to pay that price. It's done. Prices are not going to reverse down. By transitory, I mean that the rate of growth in price increases will slow down. Take a listen.
The concept of transitory is really this. It is that the increases will happen. We're not saying they will reverse. That's not what transitory means. It means that the increases in prices will happen. So there will be inflation, but that the process of inflation will stop. So that there won't be further. When we think of inflation, we really think of inflation going up year upon year upon year upon year. That's inflation. When you have inflation for 12 months or whatever it may be, I'm just taking an example, I'm not making an estimate, then you have a price increase, but you don't have an inflation process. And so part of that just is that if it doesn't affect longer term inflation expectations, then it's very likely not to affect the process of inflation going forward. So what I mean by transitory is just something that doesn't leave a permanent mark on the inflation process. Again, I don't mean that producers are going to take those price increases back. That's not the idea. It's just that they won't go on indefinitely.
Now here's the problem. If my rent went higher by 15% this year, and then it goes higher by 5% next year, according to Powell, inflation is gone. It's transitory. But if my wages didn't keep up, meaning if my wages did not go higher by 15% this year and another 5% next year, net, I'm down. My purchasing power is down, and my quality of living is down because I'm paying more for rent than before. Matter of fact, when we look at real average hourly earnings growth, we're down, folks. All of you celebrating the wage inflation, this is what's actually happening. When you pin wage inflation to the rate of growth in inflation, we're actually down. And how does that help, by the way? When the rate of growth slows down, but we're paying the same high prices, how does that help? Yet they're going to tell you inflation is already gone, it was transitory, yada, yada, yada. Reason number two, most economists don't really understand the nature of inflation. So if you are in class right now, raise your hand and tell your professor, hey professor, cut the bullshit already, let's wrap this class. Right? This is voodoo science that you're teaching right now. You have no clue what you're teaching, and neither do I. So let's wrap it up already and cancel this class and give everybody A's. I don't guarantee that you're going to get an A, but as Matt Damon says, fortune favors the brave, right? Got to take a shot once in a while. But here's what economists don't understand about inflation. It's like a tornado. You can stimulate all you want, but once the cone appears, that is the moment, right there and then, to stop stimulating right away, because the Fed's job is to be proactive, not reactive. The Fed's job is to prevent inflation, not to wait for it to happen and then react. And by the way, the cone was already out there since April of this year. And we said back there and then, the Fed must start tapering right now. They must start anchoring inflation expectations down so that cone can be sucked right back up and no harm done. But they dismissed the cone as, oh, it's just reopening impacts. It's just transitory. And now that the tornado already landed, they're doing damage control. Now they're acting. Well, you know what? It's too late. All you can do at this point is to steer that tornado one way or the other. via the fiscal policy. But the source of this tornado is the monetary policy. Hence, the cure should come from the monetary policy, not from the fiscal policy. And you and I know from history that once the tornado is born, it has to work its course. There is nothing you can do. And this is a similar story with inflation. Once it's born, there is nothing you can do to kill inflation. And from the 1970s example, there are certain policies that the government can implement which will do more harm than good, meaning making that tornado even stronger and more powerful. The only proven remedy from what we know right now to kill that tornado is jacking interest rates aggressively higher, aka the Volcker approach. So is this what the Fed is about to do? Because if not, inflation will get even worse, regardless of the little dents and the little manufactured slowdowns we're going to face along the way. Unless the Fed is really serious about raising interest rates higher to curb this inflation, inflation will come back better and stronger. Case in point, look at what's going on with lumber prices. The Fed was bragging earlier in the year. Look at lumber prices. It's the best evidence for transitory inflation because it went higher and then it crashed down. Well, guess what's going on right now? Lumber prices are moving higher again. Matter of fact, they're up over 100% since the bottom. And this will happen with grains prices, with crude oil prices, with natural gas, with softs prices. They will get hit along the way. The problem is inflation in these prices will come back stronger and better than before. So long as the source that gave birth to this inflation, meaning the monetary policy, the loose money all over the place, if that doesn't stop, inflation will keep coming back and back and back. So what does that mean to the stock market and the economy? Either the Fed will realize their mistake and start tightening seriously, meaning ending all purchasing programs this month, meaning this upcoming week, tapering everything and setting a framework for raising interest rates next year. If they do that, then inflation will get hit hard, and we should cross our fingers that the damage will be minimal to the market and the economy. The likelihood is it will not, but you can cross your finger and hope. Scenario number 2, if the Fed says, you know what? We think the December reading will be down due to energy prices moving down, and therefore we might taper, but we're not going to raise interest rates. Well, guess what? We're going to have a momentary orgasm all over the place, and then inflation will come back even stronger, and they will have, at that point, they will have to panic again and raise interest rates more aggressively than before. That will indeed cause an economic crisis and a market crash the likes that you and I have never seen before. So this upcoming week is extremely critical regarding the Fed's decision on what's going to happen to the economy and the stock market. And we have a lot of interpretations here about the CPI data. The stock market, of course, went higher on Friday. What does that mean? The stock market is saying, you know what? We'll believe it when we see it, Mr. Powell. We're calling your bluff right now that this CPI reading is the peak and you're not going to aggressively taper or raise interest rates. We dare you, Mr. Powell. We dare you to raise interest rates. This is the message from the market. It's delusional, of course, but this is what the market said at least on Friday. There is another school of thought that says the highest inflation reading in 40 years will force the Federal Reserve's hand. They have no other choice. Look at food price inflation. How can you be sitting at the helm of the Federal Reserve and you ignore one of the most dangerous inflations out there? Food price inflation. Yet again, the other school of thought says the CPI reading is perhaps the peak, and this will allow Powell to concentrate on the full employment narrative, not inflation and price stability. What does that mean? It means he might taper, but in all likelihood, he's not going to raise interest rates higher. And this is the debate back and forth until we get Jerome Powell's statement. And most importantly, by the way, the Fed's dot plots. We want to see what other members are thinking. And if the dot plots indicate a faster and sooner interest rate hikes, then the market will crash. But if the dot plots show that other members in the Fed perhaps are thinking about 2 interest rates hikes, maybe in September of 2022, maybe later than that, then the market will rejoice and move higher. But here's another problem from the CPI reading. The rally in the stock market so far has priced in a massive spending bill, trillions and trillions of dollars, in so-called infrastructure bill and other spending. Well, this CPI reading, the highest reading in almost 40 years, is going to give Joe Manchin a vindication. And this is according to the Wall Street Journal's editorial board. They say that Manchin has his vindication now to hold strong and not budge. He's not going to vote for excess spending. What does that mean, by the way? Remember the stimmies that are now in the form of child credit payments? That might be cut right away, and therefore the consumer purchasing and spending power will go down with it. So if the market is pricing in 3 trillion plus in spending, what happens if we get 1 trillion or less than 1 trillion? The likelihood is it's going to be over 1 trillion, but yet that's not 3 trillion. So those expectations of massive spending will have to be adjusted down by the market. And lastly, before we move on, here's a stupid headline from Business Insider that says Jerome Powell is popular among millennials, a survey suggests. Maybe it is because he seems to care more about finding them good jobs than protecting boomers' savings from inflation. This is perhaps the dumbest headline I have ever read in my life. The Gen Zers and millennials right now are rejoicing and celebrating Papa Jerome. He's the best, right? Look at our stocks and cryptos. Wait till all of that crashes, and then they're going to turn against Powell. I would say that Powell is the worst thing that ever happened to millennials and Gen Zers, because they will never see a bull market again after the crash. They're not going to be able to afford homes, certainly. Their quality of life will go down, all due to his stupid decisions. But I would argue that Powell is the best thing that ever happened to boomers. When you think about it, boomers have it on a silver platter. The luckiest generation ever. They got to buy houses cheap, they got to invest at cheaper prices, and now they get to retire at the highest stock market ever, the biggest bubble in all times. And they can cash in at the top of the market and enjoy retirement. All of these luxuries will not be available to millennials and Gen Zers. Thank you to Jerome Powell, but not just him, the Federal Reserve as an organization, because this engineering of the system benefits the rich and the older generations and punishes, keyword punishes, the poor, the middle class, and the younger generations. And of course, in this debate between Gen Zers, millennials, and boomers, the Gen Xers are saying, you know what, leave us out of this. We're good. Anyhow, folks, we gotta move on here to cover the markets information, starting with the performance, and here we go. The Dow Industrial Average on Friday closed in the red by 216.30 points, or a gain of 0.60%. The Nasdaq also closed in the green by 113.23 points, or a gain of 0.73%. The S&P 500 also closed in the green by 44.57 points, or a gain of 0.95%. What about the sector's performance on Friday? Leading the pack at number 1 and capturing the gold medal, consumer defensives. And at number 2 for the silver, technology, aka Apple and Microsoft. And at number 3 for the bronze, energy. The laggards of the day led by healthcare and communication services. What about the performance for the week? Pretty much every single sector closed in the green, no exceptions at all. The gains were led by technology, materials, and energy. What about the advance to decline ratios on Friday? We had a massive rally, right? But here it is, the NYSE 49% advancing versus 48% declining. The Nasdaq, the massive rally in the Nasdaq on Friday. Well, here it is, advancing 37% versus 59% declining. What does that say? The rally pretty much was on the backs of Apple and Microsoft, but specifically Apple, the options market manipulation that's going on in that stock right now. Moving on to futures and commodities, what's going on here? On Friday, crude oil prices closed in the green, a gain of about 1.5% for the WTI and a gain of a little over 1% for Brent. Yet we also had gains for gasoline, heating oil, and natural gas rallying by about 2% on Friday. What about softs? We had declines for coffee futures, perhaps topping here. Likewise, we had declines for OJ futures down about 2%. Cotton futures also declining by a little less than half a percentage point. Yet we have gains led by lumber. Look at the rally in lumber, now reading above 1,000, gaining over 4% on Friday alone. Likewise, we have another gain here for cocoa futures of a little below half a percentage point. Meanwhile, sugar futures closing pretty much on the flat line. What's going on with metals? Gold still waiting and waiting and waiting for the dollar and the bond market, therefore pretty much flat. Likewise, platinum is flat, silver scoring some gains here for a little under 1%. Yet we have losses led by palladium. Palladium down big, over 3% on Friday, and copper almost losing 1% on Friday. What about meats? Green across the board, modest gains for live and feeder cattle futures. Meanwhile, lean hogs coming back with gains over 3.5% on Friday. What about grains? We have gains here led by soybean meal, wheat, soybeans, rough rice, all gaining on Friday, while we have corn, oats, and canola on the flat line. On the other hand, soybean oil futures declining by over 2% on Friday alone. And let's take a look at some charts here, starting with OJ, orange juice. What's going on here? Are we seeing, from a daily chart perspective, a reverse head and shoulder formation and perhaps an opportunity to buy OJ contracts here? It certainly appears to be the case. In contrast, here's the chart for oats, a weekly chart. Look at this massive rally, almost 200% bottom to top, but Are we topping here? Is it the top indeed? We're seeing the MACD indicator curling down or we're about to cross. The RSI indicator highly stretched. It's been stretched for weeks now. It needs to pull back. Are we about to see the pullback? My hunch is the rally in oats, the best of the rally in oats, is pretty much over, and we need a pullback from this point on. Now, what about wheat futures? What's going on here from a weekly chart perspective? We have a trend line. There is a divergence higher from the trend line, meaning we should have a pullback top to bottom of around 16% to revisit the trend line once again. When we visit a daily chart for wheat, are we seeing a head and shoulder formation, which will also take us down at least to revisit the trend line? Moving on to the big casino, the options market. What's going on here? On Friday, the action was hot, and the hottest table remains Apple, with over 2.7 million contracts. Almost 67% of those were calls. And here it is at number 2, Ford Motor, with over 1.3 million contracts. About 78% of those were calls. There was a gamma squeeze here in Ford. I own the stock and I don't mind the squeeze at all. But this stupidity has to stop at some point because all what they're doing is a series of pumps and dumps. As a stockholder, when your stock becomes a meme stock or a gamma squeeze stock, what do you do here? You sell upside calls out of the money to raise cash. And this is exactly what I'm doing with my shares of Ford. But here it is at number 3, Tesla, with a little over 1 million contracts. About 54% of those were calls. What about the unusual activities that took place in the options market on Friday? Starting with the ticker MKC, here it is, folks. McCormick, we're talking about condiments, spices, all these prices are surging higher. Well, guess what? The beneficiary here is McCormick. And therefore, they're buying calls, the 100 calls, and they're buying a lot, by the way. This is not just the only trade that I saw. But in this case, they're buying the 100 calls for the expiration date January 21st with expectations that the name will pop higher by more than 10% by then. They paid about 90 cents apiece to enter this trade. All in all, spending about $2.5 million. And what about the trade for the ticker F for Ford? They're buying the 23 calls for the expiration date December 31st. With the expectations that Ford could pop higher by more than 7%, they paid about 45 cents apiece to enter this trade. All in all, spending about $600,000. And what about the ticker ABBV for AbbVie? Another name that I own in my portfolio, and it's been performing pretty good as of late. Perhaps the reason is the rush to safety, actual safety, high cash flow, high dividend kind of stocks. In this case, they're buying the 140 calls for the expiration date February 18th, with the expectations that the name could pop higher by more than 11.5% by then. They paid about $1 apiece to enter this trade. All in all, spending about $1.5 million. What about the trade for the ticker LCID Lucid Motor? They continue to buy calls here, short-term calls, in this case the 41 calls, for the expiration date December 17th, meaning next week, with the expectations that the name could pop higher by more than 9%. They paid about $1 and 15 cents apiece to enter this trade. All in all, spending about $1 million. What about the trade for the ticker TLT for, you guessed it, the TLT? They're betting the bond prices will move down, even as Powell is about to issue his remarks. This is interesting. They're buying puts here, the 138 puts for the expiration date January 14th, with the expectations that the name could drop down by more than 7%. They paid about 40 cents apiece to enter this trade. All in all, spending about $300,000. And what about the trade for the ticker ARKK for Tesla, which Archegos 2.0. They're buying puts here, the 85 puts for the expiration date December 23rd, with the expectations that the name could drop down by more than 11.5% by then. They paid about 70 cents apiece to enter this trade. All in all, spending about $350,000. What about the trade for the ticker IWP? This is the Russell 2000 mid-cap growth. They're buying puts here, interesting, specifically the 102 puts for the expiration date January 21st, with the expectations that the name could drop down by more than 10% by then. They paid about $1 and 20 cents apiece to enter this trade. All in all, spending about $500,000, also known as $500,000. What about the trades for the ticker UAL, United Airlines? It's a put spread, intelligently done by the way. They bought the 41 puts and they sold the 40 puts, all for the expiration date January 7th. They paid about $1 and 20 cents apiece for the 41 puts that they bought, and they received about $1 for the 40 puts that they sold. All in all, the entry cost is reduced to about 20 cents apiece. Therefore, all in all, spending about $100,000. And the maximum profit is $1 apiece So you invest 20 cents to make $1. Not bad. Risk versus reward, of course. And lastly, what about the trade for the ticker AMC for, you guessed it, AMC. They're betting that the show is over here, folks, by buying the 26 puts for the expiration date December 23rd with the expectations that AMC will drop down by more than 5%, breaching the most important support for 26. And they paid about $2.30 apiece to enter this trade, all in all, spending about $1 million. Moving on to the heat map analysis. What's going on here? This is the weekly heat map, of course, and pretty much it was a rebound week. The main theme is everything in the green with few exceptions. The problem is a lot of the green that you see on the map right now is merely oversold bounces, oversold rebounds. These are going to fade away, so we're not going to pay attention to them. But when you look at the theme, absent of the oversold bounces, you can see some defensive theme in the market here. Number one, they're buying the big cap names. Microsoft, Apple, Google, Meta, Amazon, moving higher. They're buying the actual safety stocks. We're talking about health insurance, popping higher. We're talking about consumer staples, also performing pretty good this week. We're talking about utilities and REITs. Not much of a safety here because we have uncertainty in the bond market. But consumer staples, health insurance, healthcare in general, and the big caps remain the safety play for now. Remember this. In a market crash, everything goes down together, no exceptions, because we have panic and selling of the ETFs, and everything goes down from the ETFization impact alone. But if the Fed is about to tighten, even as to go far as raising interest rates abruptly, not the entire market is going to crash. The leadership will rotate. Certain stocks that you thought about as winners, they're going to become losers. And certain stocks that you thought about as boring and all, they become winners again. So the mentality has to shift here from growth and momentum, perhaps to cash flow and dividends. But we have to wait for the final decision from Jerome Powell, which is coming this week. When we switch to the weekly ETF heat map, what do we see here? When we look at the indices, the Qs, the SPY, you would be left with the impression that the market is rebounding higher and everything is hunky-dory. But the devil is always in the details. Yes, the market is moving higher due to the performance of big caps, but when we look at the ETFs, flat, boring, nothing is going on here. Certain gains here and there, for example, for the SOXL chips. But remember, the majority of the gains came from the value chips, not the growth chips. The NVIDIAs, the AMDs actually lagged this week. We also have another consistent theme here in consumer non-discretionary, the XLP, including consumer staples, gaining 2 weeks in a row now. So if there is a theme that you can follow, is the fact that consumer staples are outperforming now. Is this going to hold or not? That remains to be seen, but it is a theme that has been consistent at least since the moment that Jerome Powell started to become more hawkish. Moving on to charts, starting with the SPY 30 minutes chart. What's going on here? We are still consolidating within the bull flag pattern. The SPY has yet to violate 466 as support. Is this bullish or bearish? The answer is it is bullish. The reason you did not violate 466 as support, the SPY continues to consolidate in a bullish pattern. What about the daily chart for the continuous contract for the SPY? What's going on here? Still yet another consolidation, a bullish consolidation, awaiting a pop higher above 4,657. That line was not violated on Friday. Likewise, we have a confirmation now from the momentum indicators, the MACD and the RSI, curling higher, and we have a crossing on the daily for the MACD, creating a green impression in the histogram, meaning the bullish momentum is starting. Now, I'm always worried about a market that rallies higher ahead of a Fed's decision because it makes the surprise element to the downside, a disappointment that the market will not get what it wants. What is the market assuming right now by moving higher? It is assuming that Powell will back off because the CPI reading is toppy, perhaps peaking, energy prices are going down, meaning the next CPI reading will be lower, and therefore Powell will back off. That is the assumption, of course, and the reason why the market is moving higher. If there is a surprise, it's going to be to the downside, meaning Powell saying, you know what, I wasn't joking, folks. I meant what I said. I'm going to taper, I'm going to tighten too. I'm going to raise interest rates starting next year. If that happens, the market will flush down right away. But for now, the path of least resistance is higher. And what about the SPX, a weekly chart? What's going on here? We are still within the range. Yes, we hit the top, we went down, not all the way to the bottom, to the lower band of the channel, but rebounded higher. So long as we're trading within that channel, so far, so good. And what about the NASDAQ 30 minutes chart? Likewise, consolidating in a bullish pattern. Yes, the NASDAQ went down, closing the gap, and then guess what? It climbed its way higher, above 397, and reaffirmed that as support. Now, is this bullish or bearish behavior? The answer is it is bullish, not bearish, because the market recaptured 397 as support once again. And here is the daily chart for the continuous contract for the Qs. What's going on here? Still not a good looking pattern here. And unlike the SPY, we have yet to have a confirmation from the momentum indicators, the RSI and MACD. They are still trading in negative territory, but that could reverse soon. The challenge will be the top candle, the all-time highs, assuming that the Qs will pop higher. Why would the Qs move higher when we're seeing the high momentum and growth getting crushed? The answer is the big caps. So long as Apple is working, Microsoft is working, Meta, Google, the market will move higher. You don't need all 5 of them to work, by the way. You just need Apple and Microsoft. These 2 are enough to keep the NASDAQ moving higher. And what about the weekly chart for the NDX? Still within the channel. It peaked a little higher. That was a false breakout. It went down, gathered some energy, and now it is moving higher again. Is it going to be able to break above the channel? That remains to be seen. But we're not going to panic and become extremely bearish on the NASDAQ until the lower end of the band is broken. And that's not going to happen, by the way, until the Apples and Microsofts of the world get shot a little bit. What about the IWM, the Russell 2000 30 minutes chart? Unlike the SPY and the Qs, actually closed in the red on Friday. A lot of people believe that the Russell is a leading indicator. I disagree. I think that the reopening names have a lot of challenges to face here. The small caps, the riskier names are getting crushed, the likes of AMC, for example. And the reopenings, a lot of doubts. It's not just the Pokemon variant. What if interest rates actually go higher? A lot of these companies are zombie companies, highly in debt, and they will take a toll on the IWM, the Russell 2000. For now, technically speaking, the Russell closed the gap at 219.40, and it started to move higher before revisiting the 218 support line. Is this bullish or bearish behavior? The answer is it is slightly bullish, because we don't have a confirmation that the IWM is indeed moving higher. Perhaps by the end of the day, we saw some short covering across the indices, pushing all of them to have a nice green candle by the end. And here is the weekly chart for the RUT, the Russell 2000. What's going on here? Still within the consolidation range, we had the false breakout higher. But until we break below 2100, we don't have a bearish confirmation that the breakout will come to the downside. In all likelihood, it will, but you gotta wait for it. And here is the DXY, the Dixie, the dollar index. What's going on here? Still holding and holding and holding for 96 as support. Why? Because it is waiting for Jerome Powell. The main move for the dollar will come after the conference from Powell. Technically speaking, it should come to the downside, but be prepared for all expectations here. Specifically, if Powell comes out a little dovish, saying, you know what, I'm going to wait on raising interest rates here. Yes, I'm going to taper everything this month, but I'm going to wait on interest rates. If that happens, then the dollar will flush down right away, losing 96 as support. What would be the catalyst for the dollar to move higher? Perhaps tightening aggressively. More hawkish means dollar goes higher. Now what about gold? What's going on here? Well, if the dollar is waiting for Powell, then gold is waiting for the dollar, and therefore no movement whatsoever here. But I'm starting to like gold here. I have a hunch that so long as gold is trading above 1,763, it could pop higher again. We could see the rally and the true safety, the true rush for safety in gold. But that will take Powell being hawkish. Powell saying, you know what, I'm going to taper and I'm going to raise interest rates. Then I think gold will catch a rally higher. But it's not guaranteed, and the reason is gold has 2 enemies. One of them is the dollar. The other enemy is the 10-year yield. And if the 10-year yield moves higher after Powell's hawkish comments, and hawkish decision perhaps, then gold will struggle to rally. But so far, the bond market's messaging has been the following. Every time Powell acts hawkish, the 10-year yield moves down, and the 2-year yield moves higher, meaning flattening of the yield curve. But every time the market gets a tease that perhaps Powell will be dovish, be it the Pokemon variant is not as serious as we thought, or the CPI reading perhaps the peak for now, we see the opposite. We see the 10-year moving higher and the 2-year moving down. What happened on Friday? Well, we don't have a conclusion here on the 10-year. It moved up, it moved down. All in all, it was slightly down, not by much. So the bond market is confused here, in my opinion, of course. But here's the most important chart in the bond market. It's not the 10-year yield. It is the 2-year yield. Why? Because the Fed has control on the 2-year, not the 10. If they're going to start to move interest rates higher, then the 2-year should move higher. And this is exactly what the 2-year has been doing, moving higher and higher and higher. What happened on Friday? It moved down. Yes, there is a technical resistance here. The upper band of the channel, I get that, but the yield in the 2-year went down on Friday. What does that mean? It means that the market is saying, we'll believe it when we see it, Mr. Powell. We're calling your bluff right now. I think that the CPI is peaking, and therefore you're not going to be too hawkish. You're not going to be aggressive. There is a lot of risk in this assumption, of course, but this is what the market is saying right now. And here's the chart for the TLT, weekly chart. Look at what happened to the TLT. Went down precisely at 149, not breaching that support by much, and therefore the mystery continues. What will happen after Powell's decision? Dovish or hawkish? Will the TLT move higher or down? Let's say Powell is dovish. Powell says, you know what? We're not going to raise interest rates higher. I'm going to wait for the next CPI reading and then I'm going to decide. The thinking is that will allow the 10-year yield to move higher, not lower, as growth and inflation expectations move higher. Ironically speaking, of course. And then the TLT moves down. Let's say Powell comes out too hawkish, saying, you know what, I'm actually going to raise interest rates. I'm not fazed or moved by a temporary dent in energy prices. What does that mean? In theory, it means that the Fed, by tapering and raising interest rates higher, the 10-year yield should move higher. But this is not what we've been seeing so far. Which means if everything stays the same, the 10-year should go down, the TLT pops higher. But what does that mean, by the way? It means a flattening yield curve, a prediction of a recession. Hey, Powell, if you raise interest rates right now, you're going to push the economy into a recession. Powell would argue and say, I don't have another choice. If we wait longer, the riskier this situation becomes, and the more aggressive we have to be if inflation indeed perks back higher again. So the mystery and the debate continues because by tapering and raising interest rates, you would think the 10-year should move higher. But this is not what we've been seeing so far. We'll adapt once the facts change. Once the reaction in the bond market changes, then we will adapt. For example, if Powell says, yes, I'm going to raise interest rates higher, and despite that, the 10-year moves higher, then we know, okay, the mechanics are taking place now. The sugar daddy is going to stop buying bonds. The bond market is finally capitulating, and we will see the end of the bubble in the bond market. Yields moving higher, bond prices moving down. But until then, we cannot assume that. We can only work with what's been going on in the past. And here it is, the VIX 4 hours chart. What's going on here? The MACD is still reading red, and it's actually moving down, and therefore the VIX is collapsing and now losing the support of 20. And this is a psychological defeat for the bears. It closed the gap. The challenge remains, can the VIX curl back higher and make that higher low? But if it continues to go down, reaching 16, it's over. You don't have a higher low. But curling back higher at any point before 16, preferably closer to 20, will mark a higher low and will confirm the thesis for the bears. The only reason behind the collapse in the VIX from 30 all the way below 20 is the fact that the market is being too complacent and so assured, assuming that Powell will not raise interest rates and therefore no need for buying puts or protection anymore. If that assumption is wrong, then the bears will win big, as the VIX will indeed pop higher again. Moving on to a daily chart for Apple. What's going on here? Still moving higher and higher and higher, pretty much vertically here, due to the massive stampede in the options market, buying calls. And of course, this is done by design. You're not going to see all these upgrades and Katie Huberty coming out of the woodwork saying Apple is going to reach 200. This is all an organized effort orchestrated in synchrony between the analysts, the manipulators, and whoever is going to benefit from pushing the price of Apple higher. And where is the SEC, you might ask? The SEC is in a coma. Doesn't matter. What matters is the psychology behind the chart. Perhaps there is a destination that they want to push Apple to. What is the next milestone that we have? The 3 trillion mark, which happens to be around 182.5. So perhaps they're going to push Apple all the way to that mark. And then the rethinking happens. When you hear the headlines, Apple at 3 trillion, and then you look at the financial sheets and you realize that Apple actually lost revenue growth quarter over quarter. And by the way, they're warning about the slowdown in demand, not just supply. Then the rethinking happens and the dumping starts. This is the assumption, of course. And I tried to call the top here. I had a put option trade on Friday that expired worthless. And you might say, why didn't you wait for the reversal, bro? The reversal happened 3 times. We had a shooting star once, twice, and a third time, and neither one of them worked. What does that mean? The limitation of technical analysis. There is another element that moves the market up or down, and that is the mechanics. And now the mechanics are in front seat, leading this move higher. I would take another swipe at it after we get to 3 trillion, 182.5, let's say they surpass that to 185. Then I'll take another swipe at it, but I'll be a little more serious here by giving myself a little more time rather than buying puts with 2 days till expiration. Moving on to Tesla, the souffle daily chart. What's going on here? The bears almost got it. They were so close on Friday because Tesla traded below 1,000 briefly in the morning. The bears have all check marks here, from the triple rejection at 1,174.5, the failure to cross in the MACD, the lower low, the break to the downside from the triangle consolidation pattern. The only check mark left is closing the day below 1,000. This makes this battle extremely fascinating. What happened on Friday? The bears were on a roll. They got so close in scoring their first victory, legitimate victory in Tesla stock in a while. The problem is, once the stock breached 1,000, we had two kind of bears. Number one, those who were holding the 1,000 puts, and those who were holding the 950 puts. The reverse gamma would have happened if we got closer to 950. The problem is, those who were holding the 1,000, as the stock started to trade down, the 1,000 puts started to trade at 20, 30 bucks a piece. That's a lot of money. And with few hours till expiration, why take the risk and hold these options for any longer? So the 1,000 put options holders, they started to close their options right away rapidly, and that started to move the stock higher. Why? Because we have bulls buying calls, the 1,000 calls, the 1,100 calls, and when the market maker sees this kind of action, says, you know what, it looks that the 1,000 put holders are bailing out, they're closing. Meanwhile, I'm seeing a lot of activities buying the 1,000 calls. So am I going to dump shares right now or hedge by buying the stock? And they're going to go with the obvious, buying the stock to hedge higher. So this action by the 1,000 puts holders left the 950 put holders left holding their you-know-what alone. But again, you cannot blame the 1,000 put holders because they had few hours till expiration. I would have done the same. I would have closed my contracts to book profits. The good news for bears is that the 950 bears did not just capitulate and moved away. They rolled their bets to next week. Not by a lot, but they're adding to that position. So again, that leaves the opportunity that if Tesla breaches 1,000, closes the day below 1,000, the reverse gamma will happen all the way to 950 and perhaps below that. And of course, if that doesn't work, perhaps the bears could hope that in the next episode of Sex and the City, they're going to bring back Mr. Big and whack him again, this time in a Tesla. That seems to be working, at least for Peloton. Next, what about tulips? What's going on here? Moving a little higher, but I'm not convinced here either. We're going to go down to 42,000 once again and have the double bottom rebound, or BTC has to recapture 53,200 and reaffirm that for support, and then I'll be interested in buying BTC. But you don't have to listen to me. You can listen to this crypto whale who bought over $150 million worth of dip in the latest crash. What about AMC? What's going on here? Not looking good. Yes, rebounding from 26, but it's just a matter of time here before the support for 26 is lost, and then game over. So watch out here, apes. You better push it higher. The problem is when your CEO, the silverback, and the other executives are dumping, do you really want to hold this stock? And here are some other bonus charts that you might be interested in. Number one, we talked about Marvell in a tweet, MRVL. It had a nice head and shoulder formation on the 1 hour chart, and indeed it went down by a little bit on Friday, but the goal is for it to close the gap at 85.47. Now, I did abandon this trade, and the reason is I was waiting for a flush down. That didn't happen. What's going on right now appears to be stretching the spring, the rubber band, only to blast it higher again. I'm not going to take that risk. It was a short-term trade. In, out, hello, goodbye. Scored a little over 100%. That's enough for me. We'll take it from there. If MRVL fails to recapture 90 once again, then I will revisit the trade. What about the ticker HSY for Hershey's? This is a weekly chart, of course. It has been in consolidation for a while, but it is moving higher, breaking the consolidation range to the upside. Is this bullish or bearish? The answer is it is bullish. On top of that, it is a consumer staple giant with the pricing power. This is exactly the kind of names you want to be in right now. And think about it. Cocoa prices did not move higher by a lot, and therefore Hershey's margins are still good. They're not contracting. But Hershey's can take advantage of this inflation by saying, you know what, we're going to jack prices higher too, because inflation, and that will expand their margins even higher. And therefore, I'm bullish on this stock, and I bought call options with the intentions of exercising these options and own the stock next year. And here is the last chart of the day for MKC McCormick. We talked about this stock a little bit in the beginning of this video, but here's the chart. A weekly chart, we have a descending line, a sloping line of resistance, and it was broken higher. On top of that, we have a fundamental story here, with spices prices moving higher due to inflation. They have the pricing power. They're going to jack prices higher beyond what they need to cover the input cost inflation. Now, I have a few profit-taking targets which happen to be resistance lines. Line number 1 happens to be 95.89. Line number 2 happens to be 98.80. But the stock can continue to run higher all the way to these levels. We have a lot of profits to capture here. So keep that chart in mind. And lastly, we're moving on to the conclusion of this video. What do we have on the economic calendar this week? Nothing on Monday. Tuesday, December 14th, we have the Small Business Index, and most importantly, the PPI, the Producer Price Index. Wednesday, December 15th, we have retail sales. We also have the Import Price Index, the Empire State Manufacturing Index, the Home Builders Index, and most importantly, the FOMC announcement and the press conference from Jerome Powell. And lastly, on Thursday, December 16th, we have, per usual, the weekly jobless claims, building permits, housing starts, the Philly Fed Manufacturing Index, and then most importantly, the manufacturing and services PMIs. And with that, ladies and gentlemen, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching, and I will talk to you again tomorrow.